Thank you for reminding me. So last session, if you remember, we ended the class with a question, which is how much would you demand over and above the risk-free rate to invest in equities as a class? And I said, go with your gut. What do you want? Do you want 3%, 4%, 5%, 6%? And the more risk averse you are, the larger the number gets. So I said, if this were the entire market and I went around the room and collected each of your numbers, the equity risk premium I'd use for the market would be a weighted average of what you gave me. Weighted by what? Weighted by how much money you brought to the table. The more money you bring to the table, the more weight I'm going to give to what you think about the equity risk premium. Let's say it's doable. Let's suppose I could do this for every single investor in the equity market. What is 70 million people? I was actually able to get their equity risk premiums and their weights. You know what my second problem is going to be? The number I get is going to be a moving number. Let me explain. I mean, each of you picked a risk premium in the last session based on your risk aversion, what you thought about it. But let's say since last Wednesday, it hasn't happened, but let's say since last Wednesday, the market has collapsed. It's down 25%. If I'd asked you the same question today that I asked you Wednesday, remember how much more would you demand? How many of you would demand a higher premium now that I've told you the market was down 25% over the last 2 days? Anybody demand a higher premium? Okay, I'm seeing some hands go up. And the rationale, Matt, I think, let me pick on somebody who picked a higher premium. Ashwin, tell me why you demand a higher premium. What happened over the 2 days that changed your risk premium?
I just feel poorer, and I'm more cautious with the cash that I still can afford and want to be more careful with how I spend it and the risk I take with it.
In other words, you got scared, right? You said,
Yeah.
why does it matter? Because risk aversion comes from within. All you need is a reminder of this is risk, and so some people, the risk premium goes up. Would there be anybody whose risk premium would be smaller today than it was on Wednesday? Sam, tell me why.
Yeah, because if the stock market goes down, 25%, then your interest rates on government bonds are fairly likely to be a lot lower. So your alternative yields are most likely going to be lower, and the risk premium is going to be
Do you
compressed.
even need that elaborate a rationale? It's a classic contrarian argument, right? If stocks were a buy last Wednesday, and now they're 25% down, they're cheaper. The classic contrarian argument is you basically find stocks to be a better buy when they're lower. The bottom line, though, is risk premiums change over time. For some people, they can go up. For some people, they can go down. See the challenge it creates? Risk premiums are dynamic. They change as the world changes, and we need an approach that captures that change. So today, I'm going to lay out 3 different ways of estimating the equity risk premium. Okay? There are 3 broad approaches. The first is to survey investors, ask them, just like I did you, what the equity risk premium they would demand is. But clearly, it's not practical to do it for all investors. I'm going to show you subsets of investors who've been surveyed. The second approach to getting equity risk premiums, and this is the default approach, is look backwards. Look at the last 20 years, the last 50 years, last 100 years, and ask the question, what kind of premium would I have earned if I'd invested in stocks instead of T-bonds, stocks instead of T-bills? And I'll show you that history. That is, in fact, the default approach. It's called the historical premium approach. It's a default approach that most analysts and appraisers use. And then I'm going to push back and argue that it's not a great way to think about equity risk premiums because it's too static, too backward looking. So I'm going to offer you a third approach that's both forward looking and dynamic. I'm going to call it an implied equity risk premium. It's going to sound fancy, but hang in there with me, even if you're quantitatively challenged, because I want you to get the intuition of what I'm going to try to do. Surveys, history, implied. Let's start with survey premiums. Clearly, you can't survey everybody. But over time, there have been services that have tried to survey subsets of investors. The Securities Industries Association used to pick 5,000 individual investors. I don't even know how they pick them randomly, and send out a survey. Basically say, what's your risk premium? How much would you demand as a return on stocks Because if you tell me what you think you will make on stocks, you've in a sense given me a risk premium, right? So if you tell me you can make 10% on stocks right now, you're telling me your equity risk premium is 9%. They stopped doing it in 2004 because they discovered it was almost completely useless. Because asking somebody what the risk premium is kind of meaningless. I can give you whatever number I feel like giving, 20%, 30%. There's no money behind the number. So what they discovered, they were getting hopes, not expectations. I'd like to make a lot of money on stocks. I'll give you a big number. So they stopped. Merrill Lynch over the last 25 years has been surveying portfolio managers. After all, they control, it's not that they're smarter, but that they control a lot of money. And they say, what do you think stocks will do over the next year? So for instance, portfolio managers come back and say, hey, we think stocks will be up 7% over the next year. You subtract out the T-bond rate from that, you get an equity risk premium. The number I have here is from 2013, 4.8%, but that number has been around, it's sticky, it's around 4.5 to 5% now. Campbell Harvey and John Graham, who are professors at Duke, do a survey of CFOs. Very different audience, right? CFOs use equity risk premiums to come up with hurdle rates in companies. Unlike portfolio managers who decide where to invest. And CFOs, and this survey again has been updated, it's now around 4%. Basically, they give you a risk premium based on what they use in the company. So you got CFOs, you got institutional investors, you got individual investors. Pablo Fernandez, who teaches in Spain, does a survey of equity research analysts and finds out what they use as equity risk premiums. And they're about 5, maybe 4.5 to 5%. Clearly, you're getting survey numbers. And perhaps the most useless survey of all. Now, Pablo also surveys academics. You know why that's useless, right? What did I say? The equity risk premium for the market is the weighted average based on what? How much money you bring to the table. Why are we even wasting our time asking academics? They don't bring any money to the table. But I guess it gets into textbooks and therefore becomes important. But the bottom line is all of these survey premiums are out there. Nobody uses them. Merrill doesn't use its own survey premium internally because they tend to be reflections of the past. In other words, if you come after a good year on stocks, the premiums tend to get higher. If you come after a bad year, they tend to get lower. So they're not reflecting expectations as much as reflecting what's happened in the recent past. The only sector where I've seen survey premiums actually used to come up with hurdle rates was real estate. Cushman and Wakefield used to survey real estate developers and investors in different parts of the country with different types of properties, residential, commercial, what they would require as a rate of return, and reported actually in a 4-page brochure. So if you're investing in commercial property in Florida, developers are requiring a rate of return of 7.5%. And the reason it used to work is the real estate development community would tend to be small and fairly homogeneous, and people used it. But even in real estate, people have given up on those survey premiums. So people can survey whoever they want, but for the most part, these survey premiums don't get used very much. Let's move to the second approach. And this, as I said, is the default approach. So if you don't quite understand what's being done, make me go over it again. So what's the question I'm asking you? What kind of premium will you earn on stocks going forward, right? Over and above the risk-free rate. Why not look at the past, right? Because stocks have been around for a long time. T-bonds have been around a long time. T-bills have been around a long time. What if I told you that over the last 50 years, stocks on average have made 7.5% a year, and T-bonds on average have made 3% a year? 7.5 minus 3 is 4.5%. That's called a historical risk premium. Now, remember, when you use this, what are you assuming about the future? That it's going to look a lot like the past, and that we'd revert back to the way things used to be. Hold on to that thought, because that can be a dangerous thought, but that's driving this approach. You think this makes sense? Let's do it. See, before I show you the table that's going to come up, you don't be surprised if I show you not one number, but a bunch of numbers. Because when I said go back in time, I didn't tell you how far back in time, and you could go back 20 years, 50 years, 90 years, maybe even 150 years. You can compute returns on T-bills versus T-bonds. But here's the table that I update at the start of every year. At the start of 2021, here's what the historical risk premiums look like in the US. Keyword is premiums. It's a number somewhere between 3.9% and 14%. That's absurd, right? That's a huge spread. You're saying, how come they're so different if they're all historical premiums? It depends on what slice of history I look at. I could go back 10 years, I could go back 50 years, I could go back all the way to 1928, which is the starting point for my data set. I could compare to T-bills or T-bonds. T-bills are short-term, T-bonds are long-term. I could even compute averages differently. I could take a simple average by taking 100 years of returns, adding them all up and dividing by 100, or look at the compounded average. My premiums are going to be very different. Analysts love this table. You know why? Because they can use whatever number they want and get away with it because it's somewhere in this table. So I'm going to push back. If you're going to use a historical risk premium, here's my suggestion. Go back as far as you can. Think of how far back I'm pushing you. 1928. 1928 was a year before the Great Depression. The US equity market, the US economy were very different then now. You're saying, you want me to go back to 1928? You know why I want you to go back to 1928? Because I remember my basic statistics. Every time you report an estimate in statistics, what are you trained to put in brackets below the estimate? A standard error telling the world, look how uncertain I am. And I'm going to follow that practice. If you ask me what the equity risk premium is for the US, I can give you an estimate, but I'm going to give you the standard error. The reason I want you to go back in time is the shorter the time period, the bigger the standard error. I mean, look at those red numbers. Those are the standard errors with a 10-year equity risk premium. Take a look at how big that standard error is. It's 4.87% if I'm looking at stocks versus T-bonds. I want to go back as far as I can. Second, I'm going to stay consistent with what I called risk-free. If you remember, in corporate finance, I said what we call risk-free is long-term T-bonds. So my premium is going to be computed over the T-bond. So I'm going to go back as far as I can. I'm going to compute it relative to the T-bond. And finally, because this premium is going to get built into a hurdle rate, which is going to become my discount rate, and I'm going to use it to discount cash flows in year 1, year 2, year 3, it's going to compound over time. And the right average that works for a compounding is a geometric average. So let me isolate my choice. I want to go back as far as I can, 1928. I want to look at T-bonds. I want to look at a geometric average. My historical risk premium for the US is 4.84%. This is false precision. You know what I mean by false precision? I'm giving you the second decimal point. It's intimidating that I know the second decimal point, but I might as well tell you the truth. That is my estimate of the equity risk premium if I go back to 1928. But that estimate comes with a standard error of 2.18%. Let's do some rounding. Risk premium is 4.8%, standard error is 2.2%. Think about the range on that risk premium. The true risk premium in the US, even if I go all the way back to 1928, could be as low as 0.4% or as high as 9.2%. Do you see how I'm getting the 0.4 and the 9.2? Take the standard error, multiply by 2. 2.2% times 2 is 4.4%. Plus or minus 4.4%. That is almost useless, right? If I told you the equity risk premium for the US could be a number less than 1% or greater than 9%, you're saying, stop helping me. This is the weakest link in historical risk premiums, is they're extraordinarily noisy. It's estimated you need about 250 years of continuous data in a market that doesn't change for a historical risk premium to become precise. Good luck with that. I mean, I could go back in the US to 1871, but in 1871, the US was an emerging market, not a developed market. It was coming out of the Civil War. And there's a selection bias because so much of this analysis is done with US data because that's where you have continuous data. We forget that in the 20th century, the most successful equity market in the world was the US equity market. So what I'm trying to say in a long-winded way is I know everybody uses these historical risk premiums, but I don't buy it. I don't think it's a great way to think about an equity risk premium going forward. So I'm going to offer you an alternative. And I'm going to use the bond market as my basis for explaining what I'm going to do. So I'm going to pick somebody. Cassandra, you're going to help me out here. Let's see how much you remember your foundations class. Don't worry, I'm not. I'll help you out as we go along. How do we compute the yield to maturity on a bond? Do you remember? What's the yield to maturity on a bond?
I'm not going to remember on the spot. We look at how long you're going to hold it and what the interest rate is.
Okay, so let's start with it. First thing you look at is the price you pay for the bond, right?
Yes.
Then you look at the coupons you're going to get on the bond because that's your cash flow. And in a bond, the bond has a maturity date. On the maturity date, you get the face value back. So I know what price you paid. I know what coupons you're going to get. I know you're going to get the face value of the bond at the end. The yield to maturity is that discount rate that makes the present value of your cash flows equal to the price. Basically, I'm saying you tell me what you paid, I'll tell you what kind of expected return you're going to get on the bond. We do this with bonds all the time because we know the price, we know the coupons, we know the face value. It's a forward-looking number, right? Because every time the price changes, the bond yield to maturity or interest rate will change. Bond price goes down, interest rate goes up, bond price goes up, interest rate comes down. So about 30 years ago, I started thinking, can I do that with stocks? If I can do that with bonds all the time, why can't I do that with stocks? So Vamsi, I'm going to put you on the spot. If I were doing a yield to maturity for the S&P 500, something like a yield to maturity. Well, instead of buying a bond, I bought the 500 largest stocks in the US, right? So you can tell me what I paid. It's the index level. Unlike a bond, I don't get coupons. What do I hope and pray I will get as cash flows when I buy stocks? What are the two forms my cash flows will take?
Dividends and
dividends. Go ahead, Cassandra, you can finish. Dividends and?
Dividends and if I, any sort of like increase in value in stock price.
That I can't count because that'd be double counting, right? Because unless I sell the stock, I don't get the increase in value. I'll get dividends, but if I continue to hold the stock and they buy back shares, that's cash coming back to me as well. So I get dividends and buybacks, but unlike a bond, I can't tell you what they will be in the future. I can tell you what they were last year. So with stocks, you have this challenge of estimating what those cash flows will be for the future. Let's say I can do that. I know what you paid for stocks, the S&P 500. I now have estimates of the cash flows you will get by buying stocks. Remember what I did with the bond? I solved for that discount rate that made the present. I do exactly the same thing with stocks. I come up with essentially an internal rate of return for stocks. And I say, look, this is your expected return on stocks given what you paid for it. I know it sounds incredibly abstract. So let me take you back to November of 2013, which is where many of these companies are set, and show you how this would have played out. In November of 2013, the S&P 500 was at 1,756.54. That's what you paid for stocks. In the 12 months leading into this analysis, the cash flows you'd have received would have been about 82.35. These are known because the dividends and the buybacks in the last 12 months I could look up on. So I know what you paid. I know what the cash flow was in the last 12 months. And in November of 2013, analysts tracking the S&P 500 were expecting a growth rate of about 5.59% a year. Now we know analysts screw up, they do terrible things, but for the moment, I've got the pieces of the puzzle nailed down. I know what you paid for stocks, 1,756.54. I take the 82.35, which is my cash flow, I grow it at 5.59% a year. That gives me my cash flows for the next 5 years. And then I'm starting to get impatient because with the bond, there's a maturity date, right? But with stocks, they keep going and going and going forever. And I can't estimate cash flows forever. So the end of year 5, I stop and say, look, I can't keep doing this. I'm going to assume that after year 5, my cash flows will continue to grow forever. Why? Because they're stocks. They don't have a finite date. And I assume they will grow at the risk-free rate. Remember we talked about the risk-free rate being a proxy for the growth rate of the economy? Essentially what I have then is what you paid up front, 1,756.54. I have your expected cash flows for the next 5 years based on the analyst growth rate. And beyond year 5, I have this 2.55% growth rate forever. I'm almost there. I solve for a discount rate that makes the present value of those cash flows equal to the level of the index. I come up with 8.04%. Now, part of you is saying, what the heck is that? Given what you are paying for stocks in November of 2013, and given the expected cash flows, you can expect to make 8.04% a year investing in stocks in the long term. The risk-free rate was 2.55%. You take the difference. The implied, I call this implied because I'm backing it out of the level of stocks. The implied equity risk premium in November of 2013 was 5.49%. If you want to round it, roughly 5.5%. I know there are a lot of moving pieces here, but think about a yield to maturity in a bond and think of doing this on stocks. That's exactly what I'm doing. So here's the challenge I face. November of 2013, I'm doing my corporate financial analysis for Disney, for Baidu, for all the other companies. I'm trying to decide what equity risk premium to use. I could do what everybody does, look at the historical premium, and that historical premium in November of 2013 would have given me 4.2%. That's a geometric average. So I can go with the historical premium. But that's backward looking, it's static. It doesn't reflect the fact that in 2008, you had this immense crisis that almost brought the market to its knees. And my other choice is I can go with this implied equity risk premium of 5.49%. I'm going to stay with this 5.49%. In fact, I'll round it up to 5.5 because why act like you know that you're more precise than you are? I'm going to use a 5.5% risk premium as my risk premium for the US because that's what I got from the implied premium. So I'll track these numbers as you go through. So in 2021, you can see what these numbers look like. But every time I've had to choose in the last 30 years as to whether I go with this historical premium, which is backward looking, or the implied premium, I've gone with the implied premium. My justification is it reflects the world I live in today, not the world I used to live in or I wished I lived in. It's a forward-looking dynamic number. And I'm saying, what do I do if I have an emerging market? For an emerging market, I'm going to argue that you cannot use a historical risk premium. Did I jump a few pages here? I don't think so, right? No, I don't think so. For emerging markets, I'm going to use a very simple way of coming up with it because I can't go back. If you gave me Vietnam and said, what's the equity risk premium for Vietnam? I can't do a historical premium. I'm going to estimate an equity risk premium for an emerging market by looking up two numbers. I'm going to start with the US premium as my base, the 5.5%. But then I'm going to estimate the default spread for the country. Remember we did this when we did currencies, where we looked at this, either the rating or the sovereign CDS. I'm going to start with the default spread. And I'm saying, if I invested in bonds issued by the country, I would settle for the default spread. But since I'm investing in equities, and equities are riskier than bonds, I'm actually going to take the default spread out for a country and scale it up, make it bigger because I face more risk in the country. I know there are a lot, again, moving pieces here, but my starting point is that 5.5%. So when you think about equity risk premium for other markets, the challenge you face is there isn't enough historical data. You have to make judgments. And to make those judgments, you got to start somewhere. And the mature market premium for the US becomes my starting point. So the way most investment banks actually get equity risk premiums for other countries is they start with the US premium. I don't know where they get it. They pull it out of thin air, sometimes historical risk premiums. They take the default spreads for a country, either with sovereign CDS spreads or based on ratings. And they add the default spread to the US premium. And they just say, I'm done. So if I tried this in November of 2013 with my three countries where I had my primary interest, India, China, and Brazil, here's what my equity risk premiums for those countries would have looked like. My starting point is 5.5%. That's my US premium. On top of that, I'm adding the default spread. For India, that default spread would have been 2.25% based on their rating of Baa3. For China, it would have been 0.8%. based on their rating of AA3. And for Brazil, it would be 2% based on their rating in November of 2013. I'm going to take that default spread, add it to my US premium. And what I get as the sum will be the equity risk premium for each of those countries. So if you go to work at an investment bank or an appraisal service and you're looking for equity risk premium for countries, this is the way in which equity risk premiums are computed. Now, of course, those are based on ratings. And you say, I don't trust ratings agencies. If you don't trust ratings agencies, you can use the sovereign CDS spreads. Remember the spreads you can get by looking at the market and what the market thinks about your default risk? You'd get different numbers, but you're building off a different base. So the most common way of getting equity risk premium for countries is to start with the US premium and just add the default spread. So when I first started looking at equity risk premiums for countries, I did this for about a year or two, and then I stopped and said, this makes no sense. The default spread is what I'm charging for buying an Indian government bond, a Brazilian government bond, a Chinese government bond. But I'm not buying bonds, I'm buying equities. And in my mind, at least, equities are riskier than bonds. And if I can somehow tell you how much riskier, I should be able to tell you what kind of additional risk premium I would charge for Indian equities. I mean, think of it as an algebra problem, right? If you're buying an Indian government bond and you're asking for 2.25%, and Indian equities are twice as risky, twice as volatile as the Indian government bond, I would assume you would charge twice 2.25%, 4.5% as your risk premium. So that's what got me started on the approach you're going to see me use to get equity risk premiums for a country. I start with the country default spread, just like the bankers do. But I look up two other numbers. One is the standard deviation, the equity index in that country. Okay, so let's take Brazil. Equity index is the Bovespa. The standard deviation of the Bovespa is about 21%. Then I look up the standard deviation in the Brazilian government bond, which is 14%. Think of an algebra problem. Brazilian equities have a standard deviation of 21. Brazilian bonds have a standard deviation of 14. 21 divided by 14 is roughly 1.5 or exactly 1.5. Brazilian equities are therefore 1.5 times more risky than Brazilian bonds. I'm going to take the 2% default spread I have for Brazil and multiply it by 1.5. It's not rocket science. All I'm doing is adding one more layer to this process to come up with the equity risk premium for Brazil. My total equity risk premium for Brazil will then be the 5.5%. That's going to be the starting point for every equity risk premium, the US premium, plus the default spread multiplied by that ratio of standard deviations. I get an 8.5% risk premium for Brazil. I use the same approach for India and China, and I end up with equity risk premiums of 6.94% for China and 9.1% for India. For every one of those, intuitively, I'm starting with a mature market premium, adding an extra premium. So if you ask me to describe how I estimate equity risk premiums, and I do this at the start of every year, I start with an equity risk premium for the S&P 500. And this might be incredibly parochial of me, but I take that equity risk premium and make it the risk premium for every mature market. I'm waiting for the question. How do you know which markets are mature? I cheat. Here's my definition of a mature market. If you get a AAA rating from S&P and Moody's, I'm going to assume you're a mature market. I know it's simplistic. I know it's sloppy, but think of how much it takes off my plate. So if you're Germany or Australia or the Netherlands or Singapore, all AAA rated countries, I give you the US equity risk premium. If you're not AAA rated, then I go through my approach. I estimate your rating, your default spread. I increase that default spread by the additional risk of equity. I come up with what I call a country risk premium, an added premium, add that onto my US premium. I've got the equity risk premium for your country. So November of 2013, here's what the world looked like to me. I'll show you what it looks like to me now. Maybe you can compare whichever your favorite or least favorite country is. Pick the country, look up the number in November of 2013. I'll show you what it looks like in 2021. So I do what I just did for India, China, and Brazil for pretty much every country in the world that has a rating. And in 2013, I stopped there. I'll show you what I do in 2021 for countries that don't have ratings. There are a few of those countries. But take for instance, Latin America. Argentina's equity risk premium is 15.63%. You're saying, are you surprised? Not really. Why is it so high? Well, I start with the US equity risk premium, which in 2013 was 5.5%. I look up the rating for Argentina. Already my stomach drops if I'm Argentinian, because what do I see as a rating? Horrifically bad. But it's not the ratings agency's fault. You keep defaulting every 4 years, your rating is going to reflect it. I take that rating and come up with a default spread. The default spread is big. I scale up that big default spread, I get an even bigger country risk premium. The country risk premium for Argentina was 10.13%. Added to the 5.5%, I get 15.63%. But look across Latin America. Notice that there's a fairly diverse range of equity risk premiums. You got Argentina and Venezuela. At that time, Venezuela was actually safer than Argentina. It's transition since. But you look at Chile, it looks much safer than the rest of Latin America. Why? Because the ratings for Chile are much higher. I have no intellectual pretensions behind these numbers. These numbers are being driven by sovereign ratings. If you get a high sovereign rating, you're going to get a low equity risk premium. If you have a low sovereign rating, you're going to get a high equity risk premium. So this is the November 2013 pic. You're saying, why do you need the world? All you have is one Chinese company, one Indian company, and one Brazilian company. Why are you looking up about Botswana and Uganda? No, you don't care about those. Don't I? To see why I need the entire world, let me take Disney. US company, right? In terms of incorporation and trading, it is a US company, but it's a multinational. In 2013, it got 82% of its revenues in the US, but it did get 18% from the rest of the world. And it broke down the rest of the world in broad geographic region terms. It didn't break it down by country. It said it got 11.6% in Europe, about 6% in Asia, 0.3% in Latin America. You know what equity risk premium I'm going to use for Disney? It's not going to be the US equity risk premium. It's going to be a weighted average of the parts of the world that they operate in. And this is something I'm going to come back to over and over again. I don't understand why people are so fixated. If you're an Israeli company and you get 100% of your revenues in the US, and there are software companies in Israel where almost all the revenues come from the US, why should I treat you like every other Israeli company? You're primarily a US company that happens to be incorporated and traded in Israel. Take Michael's company. So Michael, you're doing Coca-Cola, right? US company. In what sense? It has its headquarters building in Atlanta. But think of where Coca-Cola makes its revenues. It makes about 40% of its revenues in the riskiest parts of the world, in emerging markets. When I compute the equity risk premium for Coca-Cola, it's going to be a weighted average of where it gets revenues. We live in a world of multinationals that through the accident of history happen to be incorporated and traded in different parts of the world. But we have to treat them for what they truly are. They're multinationals. They get their risk from all over the world, and equity risk premiums need to reflect it. And it's not just Disney. Remember Vale? Brazilian mining company? You know what its biggest market is? I tell people, whenever you're asked a question in business and you don't know the answer, just say China. It's amazing how well it works. Why are interest rates low? China. Add a sense of profoundness to whatever you're saying. China is the answer to pretty much every question. Vale's biggest market is China. In 2013, Tata Motors, China was the second biggest market. You know that today China is Tata Motors' biggest market. You think, but I don't see any Tata Motor cars in China. Jaguar Land Rover, which is part of Tata Motors, gets a big chunk of its revenues in China. With every one of my companies, I'm taking the revenues, I'm looking at where they come from, I'm taking a weighted average away. But let me ask you a question, why am I using revenues? Why did I pick revenues? Julie Richardson, why do you think I picked revenues?
Because that's where your income and cash flows come from?
Well, part of it is desperation. It's probably the only metric that companies break down geographically. Take up my challenge. Take a company, look at what breaks down. The only metric they usually break down geographically is revenues. Some will report EBIT or EBITDA by region, but I wouldn't trust those numbers further than I can throw them. You know why? Magically, Ireland seems to be the most profitable part of the world, no matter what kind of multinational. Maybe it's got something to do with the tax laws. So the reason I pick revenues is I can get it for most companies, and it's the least contaminated by accounting. And that's a good thing. You know the other thing that our revenues are going for them? They're always positive. And that's a good thing because your weights can then be positive as well. It's not perfect. There are some companies, especially oil companies, natural resource companies, where you can argue the risk doesn't come from where you sell your stuff, it comes from where you make the stuff or where you get the stuff. So if I were doing an oil company, I'd base my equity risk premium based on production. But revenues become an easy device to come up with weighted averages, and you can see how this plays out with the equity risk premiums. Now, I'll give you another reason I like implied equity risk premiums. Remember I said they were forward-looking and dynamic? In fact, I started the class with this experiment, right? What if I told you that stocks were down 25% over 2 days? And many of you said, look, my risk premium will change, either up or down based on that. I want an equity risk premium that reflects that fear factor. You know what? During a crisis, I get a chance to see the equity risk premium play out in real time. In 2008, so you remember the last quarter was a horrifically bad quarter. And starting September 12th of 2008, every day I used to live in New Jersey, then I'd commute in on the train. And every morning I'd torture myself by doing the following. I'd compute the implied equity risk premium for the S&P 500 that day. You think, how much can happen in a day? Well, clearly, none of you was around in that last quarter of 2008, but lots happened every day. The market would be up 1,000 points, down 1,500 points. So I computed the implied equity risk premium by day. You're saying, why do you pick September 12th? September 12th was a Friday before the Lehman collapse. And of course, once Lehman collapsed that weekend, the crisis began. Take a look at the numbers. When I started this calculation on September 12th of 2008, my equity risk premium was about 4.4%. Very close to what it was at the start of 2008. There was a day in November, 2 months later, where the equity risk premium for the US, the S&P 500, was 8%. Think of it, it almost doubled in 2 months. That was shocking because this was supposed to happen in emerging markets. This happens all the time. This was not supposed to happen in developed markets. Everything we knew in finance was upended. But the equity risk premium went from 4.4 to 8%. In fact, it ended the year at 6.4%, well above where it was before the crisis. Why? For a good reason. People were scared and they were building in that fear factor into a higher risk premium. And once I did that in 2008, it's a playbook I've returned to every time there's been a crisis. So whenever there's a crisis, I start computing risk premiums by day, partly to keep my sanity, because if I listen to the experts in the middle of a crisis, I'm going to go crazy because they have no idea what they're talking about, but I'm going to be reactive. So I say, I'm going to go back to basics and see what the market is telling me. So February 14th of last year, and this should be well within your memory. You know what kicked in, right? The Italian government announced that they'd found 200 COVID cases in Italy. And we all had to wake up to the fact that this virus was not going to stay restricted to cruise ships in China. The COVID crisis started. And between February 14th and March 23rd, take a look at, see the gray line. I'll talk about the gray, the black line. See the black line? That actually is the equity risk premium by day. The equity risk premium for the S&P 500 went from about 4.7% to 7.75%. Looks a lot like 2008, right? That big jump in risk premiums. On March 23rd, the implied equity risk premium for the S&P 500 is close to 8%. It's starting to look a lot like 2008. But here's where 2020 was different from 2008. Take a look at what happened to that risk premium over the rest of the year. In 2008, the risk premium dropped, but it stayed well above where it was before the crisis, 6.4%. In fact, it stayed well above the number before the crisis for almost 3 years. The scars took a long time to heal. In contrast, in 2020, by the time you got to September of 2020, equity risk premiums had dropped back to where they were before the crisis. And by December 31st, the implied equity risk premium in the US was down to 4.72%, below where it was before the crisis started. Something about the 2020 crisis, and I don't even know, we can talk about different things, led people to say, what crisis? By the end of the year, they were pricing equities as if there were no crisis at all. In fact, to show you that 4.72%, let me show you what the numbers look like at the start of 2021. So this is after one of the most, in terms of personal life, this was a bigger crisis in 2008. We were all stuck in our home. The economy was shut down. We'd all agreed this was a crisis, but the market seemed to just blow it off. The start of 2021, if you looked at the S&P 500, 3,756.07, and you did exactly what you did in 2013. Take expected cash flows, put in a growth rate beyond year 5, solve for an expected return. The expected return you got is 5.65%. You remember what it was in November of 2013, anybody? You can look back if you want. I think it was 8-point-something%. In November of 2013, investors were pricing stocks to earn 8%. Now they're pricing stocks to earn only 5%. You think that's terrible, that's too low a number. But take a look at what's happened to the T-bond rate. It was 2.55%, it's now down to 0.93%. That difference is the equity risk premium. It's 4.72%. This is the number that you're looking at the start of the year, is the price of risk in equity markets. Now, you can disagree with that number, you might not like it, but this is a market price for risk. Whether you like it or not, it is something that has to enter into your calculation. I know I bulldozed my way through. Any questions on the intuition of what I'm trying to do and why it's changing during a crisis? Because if you can get this, I think you cracked the code to kind of understanding what causes markets to move and how that plays out in both corporate finance and valuation. So I'm going to pause and give people a chance to ask questions if they do have any about the implied premium. Go ahead, Julie.
This was from a couple slides earlier, but is the growth rate that you put in based on historical values?
Oh, the growth rate I used to get the implied equity risk premium is an analyst estimated growth rate, because it's, and the analysts I use are actually what I call top-down analysts. These are analysts who track the entire earnings for the index. Guys like Ed Yardeni does that, FactSet does it. So it's less subject to bias, because the problem you get with analyst projections of growth, if you go from the bottom up, individual companies, is they tend to overestimate growth. So if you look at history, these top-down estimates have been pretty good. They're off, but they're off in both directions. Sometimes they overestimate, sometimes they underestimate. So I'm trying to bring in market expectations of growth into the earnings. And right now the growth is very high. You know why it's very high going out of 2020? Because your base year is 2020, which was so damaged by COVID that coming back from it is going to create the short-term growth. It's not that market companies are growing revenues, but their earnings are recovered. Is everybody clear on the intuition as to why when stock prices drop, equity risk premiums go up? Think about bond prices and interest rates, right? You pay a lower price, you get a higher return on the bond. Same rationale. Genoa, sorry.
Yeah, Professor. My question is that we calculate the implied equity risk premium to use it in the long term. Like we discount the cash flow for a project in like 10 years, 20 years. But in the short term, the market may make mistakes. People can panic and change the price of the index. So we may get inaccurate equity premium. And
you're always going to be accurate. The inaccuracy doesn't worry me because you're never going to be accurate. The question is, will we get a biased equity risk premium? Too low or too high? And your point is a good one. And to see what you mean, let me show you the history of equity risk premiums. This is a history of equity risk premiums going back to 1960. In 1999, see what the equity risk premium was? It was 2%, the peak of the dot-com boom. If I were a corporate finance analyst or a valuation person and I used the 2%, I'm clearly using too low a number, right? I'm basically building in too low a premium. I'm going to come up with high values for companies. I completely agree. But here's why I still want you to use the implied premium today. When I ask you to value a company, let's say it's Coca-Cola or Airbnb today. If you read your mission statement, you know what I'm asking you to do? Tell me the value of Airbnb given where the market is today. I'm not asking you to pass judgment on the S&P 500, tell me the market is overvalued, because I want you to value a company. When I value individual companies or do analysis of individual companies, I'm going to stick with the implied premium. But you could then ask me a different question, right? What do you think about the overall market? You think the overall market is over? And you know how I'm going to pass judgment on that? I'm going to take the implied equity risk premium today. I'm going to look at history and say, hey, you know what? Right now it's 4.72%. The historical average is 4.2. If I go all the way back to 1960, I'm okay with 4.72%. But in 1999, if you'd asked me that question, I'd have looked at the 2% and say, you know what? You should be scared. And if you're scared, you should have less money in equities as a class and take your money out of stocks. And if you've taken that advice, it would have been good advice. And then if you ask me, now that I have only 20% of my money in stocks, which stocks should I buy? I'm going to go back to the 2% premium. So what I'm doing is I'm separating what I think about the market from what I think about individual companies. And that's why I am a proponent of using implied premiums, even if they look low or high in valuation, because you're asking me for the value of a company. And if I bring in my views about the market into my views of valuation of the company, you never know what led me to find a company to be cheap or expensive, because both views get melded together in the same valuation. I'll give you an example. If I used a 6% equity risk premium today to value Coca-Cola, I'm going to find it overvalued. And then if you ask me, why do you think Coca-Cola is overvalued? The truth might be, it's not that Coca-Cola is overvalued, but I think the S&P 500 is overvalued. So this allows me to separate the two judgments and say, valuing companies, I'm going to use the implied premium today. But if you ask me, is that the right premium? I'm going to look at history to allow you to make a judgment on whether the overall market is under or overvalued. Michael?
Yeah, you had mentioned that lower stock prices would create higher premiums just because there's a bigger sort of spread.
You don't sound like you're convinced by what I said.
No, I am, but I'm just wondering if it works the other way also. In other words,
yeah.
if the market gets
prices go up, if stock prices go up and earnings don't, because remember, both go up, the equity risk premium doesn't change. Both earnings and stock prices go up. Both earnings and stock prices go down, your equity risk premium doesn't change. It's when one moves disproportionately relative to the other that you have a problem. So if stock prices go up 50%, but earnings don't change, you have what happened in the 1990s. You know why equity risk premiums for the last decade have not? Because if you look at stock prices, they've gone up immensely, right? Threefold in the last decade. You're saying, how come that's not showing up as a lower equity risk premium? Because earnings have also gone up threefold since 2010. Cash flows have also gone up threefold. So what you have is a collective rise in all of the variables. Right? So what causes equity risk premiums to change is a disconnect between what's happening to stock price and what's happening to earnings and cash flows.
So I guess the way I was thinking of it is if the market gets news for like what happened in February, March, that would cause their equity risk premiums to go up. Just internally, everybody would need higher risk premiums now. Wouldn't that just the natural reaction would then be that at the current prices there'd be more sellers than buyers, and that would cause the price to go down?
Yeah, I mean, demand and supply is what causes prices. That's why I'm saying equity risk premiums are a consensus view. If we're all more scared than greedy, equity risk premiums are going to go up. If we're all more greedy than scared, Equity risk premiums are going to go down. And that's why it's almost a magical number, because it plays out all our views in that one number. It's captured in that number. It becomes a number that I can track. And that's why I said, when I'm scared, when I'm in the middle of a crisis, I start doing this every day because it keeps me grounded. It says, look, relative to history, this is where you are. This is where you should expect to be. Look forward, because what's happened is explainable. What's coming in the future is what you should be basing your decisions on. Julian, another question?
Yeah, just one more question.
Yeah.
Can you then start to kind of look at demographics and see who has the disposable income to act riskier?
And that's, I think, one of the questions you could ask. What is it about 2020 that's different? Maybe the fact that the people who have the money to invest in stocks have actually not been hurt that much by this crisis. They still have their jobs, they might work from home. The people who've been hurt the most are the people not investing in stocks. So it might be part of the reason why in 2020 you saw this very quick recovery, because people said, I'm shut at home, I hate it, but I still make the same paycheck and I feel okay with the disposable income. So that's why I think there are macro reasons we can give for what happened. But that doesn't change the fact that this has been a most unusual crisis in terms of how quickly the fear factor seems to have dissipated, at least when it comes to stock prices. Leander?
Hi, Professor. I want to ask a technical question. So when you calculate the dividend payout and the buyback price of the whole SP 500, how did you get these numbers? Do you add?
Well, it's very easy, right? Because S&P actually reports them end of every quarter.
Okay.
In fact, I'll give you the dates they report them. It's March 15th, June 15th, September 15th, and December 15th. The S&P will report this was what dividends and buybacks were for the index in the last quarter. But even if S&P did not report it, remember that link I sent to you to S&P Capital IQ? You don't even remember, right? But you can actually get into S&P Capital IQ. You can download the 500 S&P 500 companies. You can get the dividends and buybacks over the last 12 months. So it's actually available in lots of public sources, and it's actually very easy to get. The growth rates, it's a little more work. I get them all, you do. There are a couple of sites I'll send you the links to where you can get expected earnings in the future.
Okay,
Juan?
thank you.
So my question is, could we interpret this equity risk premium like a forward-looking price-to-earnings ratio?
Well, it affects the forward-looking price-to-earnings ratio. It's not that price-earnings ratios are incomplete. You know why they're incomplete? Because they don't consider the alternative. What's the alternative? That rates are really low. So when you just look at PE ratios, stocks look overvalued today. It's not even close, right? 25 times earnings. We've never paid that before. But let's face it, if you did not invest in stocks, you invest in T-bonds, you're making 1%, which you've never seen number. This is a composite number. It factors in what you're paying for stocks and interest rates and expected growth. So it brings in all of the fundamentals, whereas price earnings ratio is taking the price today divided by earnings last year. And you're not bringing in the growth factor, the interest rate factor, and the other issues. So it's a more complete number than focusing on a PE ratio. Dan?
Do you feel like investors don't have an alternative? Because like you're saying, like inflation's like kryptonite to bonds. So they have to funnel their money into riskier assets.
Tell me that, let's not make it abstract. You don't like stocks, you think they're overvalued. You don't like interest rates, they're too low, which I think a lot of people would agree with those two statements. Where are you going to put your money? You say, how about real estate? Real estate behave a lot like stocks and bonds now. Cap rates in real estate are at historic lows. Maybe this explains at least some of what you're seeing with the cryptos, right? In a sense, desperation says, you know what, I give up on financial assets. I'm going to go bet on what Bitcoin will do in the next 5 or 10 years. But this is a very unusual time in terms of investment choices. And the older you are, the more this bothers you. Do you see why? Because you grew up in a market where you made 10% on stocks and 5% on T-bonds, and the cap rate was 8%, and everything looks expensive to you because you're scaling it against. But you got to live in the world you're in. This has killed value investing as a type of investing because people are so caught up in comparing things to the past. Kushal?
Yeah, Professor, you talked about comparing this risk premium to history. What about comparing
to the history of my implied premiums, not the historical premium, the history.
What about comparing the overall return, like the premium plus risk-free rate?
Then we're in trouble, right? Because now we're settling. And did everybody get Kushal's point, which is the equity risk premium looks okay, 4.72%. But the 4.72 plus the 0.93% gives me 5.65%. That is a historic low. It goes to Dan's point of, if I'd offered an equity investor 5.65% in the late 80s, I'd have been laughed out of the room. Are you crazy? I can make 6% on bonds. Even in the 1990s, you could make 4% on bonds. Even 10 years ago, you'd make 2.5% on bonds. The only reason 5.65% looks good is because your alternative is 1%. We're kind of locked at the hip in this low yield, low rate, low expected return world. And my worry is that people are not factoring that in terms of how much they save for pensions or for their future, right? Because the old rules are based upon you can make 9 or 10. And the state of New Jersey is still basing how much money it sets into pension funds on a 9% expected return on stocks. This is a disaster waiting to happen around the country because people base their, so when you bring an actuary in and say, how much do you need to set aside for a pension fund? They're basing it on unrealistic numbers given where the market is today. Tom?
Is there any kind of predictable relationship between what the equity risk premium is and the risk-free rate?
It's an empirical question, right? So the way you do it is you look at 60 years of equity risk premium, and look at 60 years of T-bond rates, and you're saying when T-bond rates are lower, equity risk premium is low, or T-bond rates are high. The correlation is zero right now. In fact, it's one of the weekly challenges I said in my valuation class. I send them the 60 years of equity risk premiums and T-bond rates and say, you figure it out. Tell me whether there's a relationship. And all you have to do is run a correlation. It's zero. At least in the US, there's been none. Though I could give you an intuitive rationale why there should be a relationship. You could argue that when risk-free rates are high, I should demand a higher risk premium. But at least in the US, there seems to be no connection, no correlation. Which brings me to 2021. So I won't bore you by repeating the process, but at the start of 2021, as I have for, this would be my 31st year reporting equity risk premiums by country, I went through the process. I started with the US premium, 4.72%, you saw that, the implied premium. I checked the sovereign rating. If it was a AAA rated country, I gave you the 4.72%. If you were not AAA rated, I looked up your default spread. And I also used the sovereign CDS if you had it. And then to compute how much riskier equities are, rather than look in each country at the standard deviation of the government bonds and stocks, which is almost a non-starter, because 75% of countries, there are no government bonds to even look at. I use one scalar. I looked at the standard deviation of emerging market equities, S&P as an index of emerging market equities, divided by the standard deviation of emerging market government bonds. So instead of doing it for each country, I did one ratio. That ratio is about 1.1, which means if your default spread is 2%, I'm going to multiply it by 1.1, give me 2.2%, add it to the 4.72%, and I get a risk premium for your country. So here's what the world looks like now. It looks a little more crowded than it did in 2013 because I've added more countries. I think I pretty much got the world covered on this page. So there's a couple of countries I put in the wrong region, and I hear about this all the time. And I'm too lazy to fix it. So I know Mauritius is not in Asia, so it should be in Africa. Somehow it got messed up. It's in the middle of the ocean there. I kind of moved it to the wrong. But it's too tiny to make a difference. Basically, again, if you look at the 4.72%, that's my US premium. It's going to show up for every country which has a AAA rating. So notice all the AAA rated countries, 4.72% is the premium. If you're not AAA rated, then of course I go through the process and I get an equity risk premium by country. This is by far the most downloaded data set on my website, by far. It gets used in the strangest places. I get an email from somebody bidding on a Lithuanian project. Geographically, you got to show me the map and said, this is where Lithuania is. And they said, do you know that they're using your equity risk premiums? The Lithuanian government is using your equity risk premiums to determine how much contracts should go for. I said, I had no idea. I get an email from the New Zealand Milk Board. I didn't even know there was a milk board in New Zealand till I got this email saying, we're using your equity risk premiums to set milk prices for New Zealand farmers. What? Who are you selling the milk to? Zimbabwe? But usually the email will say, well, how do you come up with these numbers? Expecting this deeply thought out intellectual rationale. I say, look, this is what I do. I get the premium for the US, I look up your default spread, I multiply it by the scaling factor, and that's what it is. There's nothing behind it. But once in a while, I do get an email and I'm not sure how to respond to it. I still remember an email I got from Lebanon. I get pretty excited. I didn't get that many emails about valuation from the Middle East. So I open up the email. It says, you have destroyed Lebanon. I said, what? After 30 years of civil war and Hezbollah, I'm the guy who destroyed Lebanon? What the heck did I do? And it turned out that this email was from a Lebanese business person whose business had been appraised for value. And the appraiser had used the equity risk premium for Lebanon from my website. It was a big number. You see why a big number is going to piss him off? Use a big risk premium, your discount rate goes up, your value goes down. He thought he'd been gypped and it was all my fault. So initially my response was, take it up with your appraiser, don't take it up with me, it's not my problem. But then I decided since the email was from Lebanon, I should be a little more discreet in the way I answered this question. I said, it's not my fault. You know whose fault it is? When you see a big equity risk premium for a country, why is the risk premium big? It's not because I don't like your country. It comes from the fact that you had so I said, it's not my fault. It's Moody's fault. And just in case you want to wreak revenge on them, here's the address. But I have nothing to do with this. There's zero intellectual firepower behind these numbers. They're based on measures of default risk. And that's a weakness. Because there are parts of the world where I think I underestimate the equity risk premium because of my focus on default risk, like the Middle East. Saudi Arabia looks pretty safe, right, from an equity risk premium perspective. Why? Because its rating is it's close to AAA rating, because there is very little risk of Saudi Arabia defaulting. They almost never borrow money. They have all these oil cash flows. But there's lots of risk in Saudi Arabia that are outside of default risk. And finally, if you look at the very top of the table, you notice a group of companies, what do they share in common? Algeria, Brunei, Gambia, Guinea-Bissau, Guyana. These are called frontier markets. It's a fancy way of saying these are markets that are so scary that even the ratings agencies don't try to rate them. Why? Can you imagine being hired by Moody's? And you walk in for your first assignment and say, hey, we're going to give you a new country to rate. You're very excited. You're giving your own country to rate. And say, what country? So North Korea. You're going to be flying out tomorrow. You probably quit on the spot, right? Can you imagine going into North Korea, giving them a bad rating? You're probably not coming back. These are called frontier markets. And for the longest time, until 2016, I did not have equity risk premiums there. Until I get an email from a Syrian businessman. There's actually one guy left in Syria still running a business. I don't know how he pulls it off. And he says, I'm trying to come up with a hurdle rate for my business. This is what this guy's highest priority is. He's in the middle of Syria running a business. He's trying to come up with a hurdle rate. And he says, I'm looking at your website and I cannot find an equity risk premium for Syria. Why? So I told him, look, it's because Syria is not rated. If you're not rated, I don't have a basis for. And he says, he's very assertive. He says, what do you expect me to do? I need a hurdle rate. And I said, you're right. What was I thinking? I'll try to come up with my best estimate. So here's what I did. I was able to find a score called, there's a service in Europe called Political Risk Services that attaches a number, a country risk number, a score for country risk. And I was able to find that country risk score for Syria. I don't know what it was at the time that I did this, but let's say it's 48. They also rate other countries. I was able to find 5 other countries with country risk scores roughly 48. 45 to 50. And I was able, and 4 of those countries had ratings and equity risk premiums. I took the average equity risk for those 4 countries attached to Syria. I think that is so simplistic. Guilty as charged. If you can come up with a better way of estimating equity risk premiums for North Korea, I'd love to hear it. But I now have a number. If you're interested in buying a North Korea or building a North Korean factory, of what you should be using is your equity risk premium. So as I said, the reason I need this is not because I plan to value a North Korean company. I don't have zero desire to do that. I don't know whether there's a North Korean company to value, but because there might be companies with exposures in those parts of the world, I need to know their equity risk premiums. I assume, I was looking at your Google shared spreadsheet, most of you have picked up companies already. And if you scan through, especially in the footnotes to the balance sheet, there will be a breakdown geographically of where your company gets revenues. So Michael, for instance, when you open this, to go to the breakdown will be by region. Coca-Cola doesn't list every country. There are too many countries, but it'll say, this is how much we get from Europe. This is how much we get from Asia. And if you go back to the previous page, I actually report weighted averages by region. You know how I compute the weighted averages? I take the equity risk premium for every country in that region, and I take a weighted average based on GDP. Basically, I'm saying if you're looking at Asia, China is the biggest market. Looking at Africa, it's Nigeria and South Africa that are going to drive. So I'm not going to do a simple average, it's a weighted average. And I do that because many companies break down revenues by region. And some of your companies will piss you off. Why? Because they'll break the world down in ways that make no sense. For instance, many companies break down revenues and they will bundle together Europe, the Middle East, and Africa. I think they just like the acronym EMEA. It'll show up as EMEA. I've never understood, what the heck are you doing bundling together Africa, Europe, and the Middle East? But the worst culprits are often US companies, because here's how US companies will often break their revenues down. We get 71% of our revenues in the US, 29% from the rest of the world. Come on, guys, you can do a little better than this. The rest of the world is an awfully fuzzy place for me to go. But don't fight it. If that's all you're given, you got to do the best you can with it. So if you get a chance, take a look at your companies to see what the breakdown is. So let's review equity risk premiums. Equity risk premiums was what we charge over and above the risk-free rate for investing in equities. You can try surveys, but they never seem to work. You can use historical premiums, but they're backward-looking and static. Or you can use a forward-looking dynamic. The way I've described it, it seems like a no contest, but that's my bias coming through. I like forward-looking dynamic premiums. So go through the mechanics of that implied premium. I'll send you my February 2020, because I do this at the start of every month. So you can get my latest premium, and the next week I'll be doing the March 1st update. Take a look at the spreadsheet to see what I'm doing. It's not rocket science. And make a judgment. Risk-free rate, equity risk premium, which leaves me with one final number to use the CAPM. I need a beta. And your very first finance class, you're ruined, because here's how you're taught to estimate betas. Here's how I was taught to estimate betas. I was taught to run a regression of returns in the stock against returns in a market index. The slope of the line, I was told, is the beta. What a horrifically bad way to be taught betas, because it makes it into the statistical number. So I'm going to start with that regression. I'm going to take it apart and argue that there is information in the regression, but then I'm going to end by arguing there has to be a better way of thinking about betas. Because when you look at a regression of returns in a stock against returns in a market index, you of course get the slope. That's your beta. You also get an intercept. I know we're going to have to delve into a little bit of statistics here, but you run a regression, you get an intercept. I'm going to argue that that intercept tells you something about how good or bad your stock was, keyword is was, as an investment during the period of the regression. So if you ran a 2-year regression, I'm telling you with the intercept, was my stock a good stock, a bad stock, or a neutral stock as an investment? And finally, when you run a regression, you get an R squared, right? And in statistics classes, what are you told? Higher R squareds are better than lower R squared. Abandon that perspective completely. because R squared in this regression carries an economic significance. It tells you the proportion of the risk in your stock that is explained by the market. Saying, so what? Remember that big deal we made about company-specific risk and market risk? The R squared tells me how much of the risk in my company comes from the market. It's risk you cannot diversify away. So I know you're getting tired, but let me at least set up this process of running this regression. When you run the regression, you get an intercept. You say, well, what do I want? You want an intercept that is, so if you think about a stock being a good investment, doing better than the market, the intercept gives it away. And to see what information there is in the intercept, I'm going to do some very basic algebra with the CAPM. In the CAPM, the expected return on a stock is the risk-free rate plus beta times RM minus RF. That's the equity risk premium in there. That's just the CAPM. I'm going to rewrite it. And trust me, I'm not changing the equation. I'm just moving terms around. If I rewrote it, the CAPM can be written as the risk-free rate times 1 minus beta plus beta times RM. Hang in there with me. I'm going somewhere with this. So if I wrote the CAPM, the risk-free rate times 1 minus beta is the intercept. Now beta times RM is the second part of the equation. When I run a regression, here's what it looks like. I have an intercept plus B times RM. Those two terms cancel out, which means if my stock did exactly as predicted during a regression time period, my intercept should be roughly equal to my risk-free rate times 1 minus beta. If my stock did exceptionally well, my intercept should be much higher than my risk-free rate times 1 minus beta. And if my stock had a terrible 2 years, my intercept should be much lower than the risk-free rate times 1 minus beta. So here's what I do. I run the regression, I get the intercept. Then I compute what the risk-free rate times 1 minus beta is going to be. I take the difference. That difference is called Jensen's alpha. You're saying, who the heck is Jensen? And why is it called an alpha? Jensen is Michael Jensen, and this is something he devised in the late 60s to test a very simple question, or test a very simple proposition. In the late 60s, people assumed that mutual funds must earn higher returns in the market. Why? Because they're run by professionals. Professionals know more than the rest of us do. So in 1968, he decided to test this by taking 125 mutual funds, which is all there were in the US then, and computing the Jensen's alpha on each fund. You remember, the Jensen's alpha should be much greater than 0 if you're beating the market, should be roughly 0 if you're matching the market, should be negative if you're doing worse than the market. Does anybody know what he found? 1968. This is one of the most enduring findings in finance. In 1968, when he took 125 mutual funds and he computed their average Jensen's alpha, he came up with minus 1.5%. Basically, he found that mutual funds collectively generated 1.5% less than the market after adjusting for risk. It's the strangest profession, active money management. I mean, the analogy I offer, it's like starting a plumbing business called Floods Are Us. And here's what you do. There's a leak in my house. I call you when you leave a flood. And you charge me. There's no way I'm paying you, right? But in active money management, that's exactly what I'm doing. I'm taking your money saying, hey, give me 2% of your money. To do what? Deliver 1.5% less than you would have made if you hadn't used me. Why the heck do you keep using me? That's a different question, but you can see collectively that active money management has always had trouble matching the market. Forget about beating the market. And those chickens are coming home to roost. In the last decade, it's become too transparent. Everybody can see it. So guess what's happened? Money's left active money managers, mutual funds, hedge funds, and actually gravitated towards ETFs and index funds. But the Jensen's alpha that started it looked at mutual funds and came to that conclusion. So I'll set up the estimation process and we'll see this play out as a regression. So let's suppose I want to run this regression on Disney. I have some choices to make. First, I have to decide how far back in time I'm going to go. Let me explain. Disney's been listed and publicly traded as a company for 75 years, since the 1950s. I could go back 75 years, right? But you know why I don't want to do that? Because if I go back that long, I'm getting a beta that doesn't reflect the Disney of today. The Disney of the 50s and 60s was a company that made one motion picture every 2 or 3 years and had one theme park in Anaheim. The Disney of today is this multi-business entertainment conglomerate. So I don't want to go back too far because then I get a company that doesn't look like my company today. But I want to go back far enough that I want to get enough data. Most estimation services use between 2 and 5 years. Second stop, I have to decide whether I want to divide that 2 or 5 year period into daily, weekly, or monthly intervals, because I can compute the returns every day. I can compute them every week or every month. And again, the choice is a simple one. If I just wanted more data, I'd use daily returns, right? There are more days in 5 years than in weeks and months, but daily returns are notoriously noisy. There's a lot of movement around. So most services use either weekly or monthly. Third stop, I have to compute returns, right? And for stocks, you get returns in 2 places. You get them from dividends, but you also get them from prices changing. So every month, the price will change. I compute the return. In some months, remember, stocks don't pay dividends in every month. There might be a dividend added on. I bring that into the return. So that's going to give me returns in Disney going back 60 months or 104 weeks. But to run a regression, I need a market index. And already you can see I have choices, right? In the US, I can use the Dow 30, the S&P 500, the NYSE Composite, the NASDAQ. We're going to talk about that index choice. And when you think about the index choice, remember what you're trying to estimate, a beta from the CAPM. And in the CAPM, what did we all end up holding with no transactions costs and no private information? The market portfolio. What was in there? Everything. The closer we get to that ideal, the better the index. Which means that Dow 30, don't even think about it. It's not an index that should even enter in. Most services in the US use the S&P 500. It's only 500 companies, but its saving grace is these are the 500 largest companies. So on a market cap basis, you're getting about 75% of all companies in there. So if you get a chance, take a look at that Bloomberg YouTube video I got where I show you how to play with the beta page. Now I asked you to print off the beta page. If you please do that before Monday's class, because you're going to both see how you can change the index, you can change the starting point and the ending point. You're going to get a sense of how the regression being set up differently can give you different betas. But on Monday when we start, we're going to take that regression apart and see what it tells us about a company. And then we're going to go further and talk about where do betas really come from. They don't come from regression, they come from choices you make. And by the end of the process, we'll have an alternative to regression betas. So that's it. And I know we went through a lot today. So if you're reading the book along the way, chapter 4 is an excruciatingly long chapter. It's layers of detail on top of layers. I won't even tell you that it's fun to read. It wasn't fun to write. But if you can make it through that chapter, you'll have the bulk of what we've done in terms of risk premiums. So I will see you on Monday.
Thank you.
Thank you.
Thank you.
Take care. Bye-bye.
Professor, just to make sure we are not estimating, we're not doing a regression, we're just taking the data.
Bloomberg database. Just take the Bloomberg page. You can do I'll send you also at the end with an email. I'll send you, if you wanted to do a regression on your own, I'll send you how to do it. It'll take you about 15 minutes with Yahoo Finance.
Okay.
Nice to be able to do, but just print off the Bloomberg beta page. You don't
All
have to run the regression.
Awesome. Thank you.